Okay, let's jump right into this explainer. Today, we're objectively breaking down the Q1 2026 financials and the massive valuation debate surrounding Select Water Solutions, also known by its ticker, WTTR. If you track the energy services sector, you've probably seen these guys making headlines lately. Well, our goal today is to cut through all that noise and just look directly at the data. Right out of the gate, we've got to address the elephant in the room. Sitting at a recent share price of $18.91, this stock has delivered a mind-blowing 112% total shareholder return over the last year. I mean, that kind of momentum absolutely demands attention. But the real reason we're here today is to figure out, is the market pricing in way too much future growth, or is this wild ride actually sustainable based on their underlying business? To figure this out, we've structured this explainer into 4 quick parts. First, the Q1 earnings numbers. Second, their strategic acquisitions. Third, tracking their financial health. And finally, the valuation dilemma.
Okay, part 1, the numbers. Let's break down those Q1 2026 earnings. And the headline figure here is definitely impressive. Select Water Solutions pulled in a massive $366 million in consolidated revenue for the first quarter of 2026. To put that into perspective, that's a solid $19 million bump from just the previous quarter. So they aren't just meeting expectations, right? They are showing clear sequential top-line growth. But hey, revenue is only half the battle. We really need to know if they're actually keeping more of the cash they generate.
Well, it turns out that top-line growth is translating beautifully into profitability. Just look at the sequential jump in adjusted EBITDA. It went up by a very healthy $13.4 million, climbing from $64.2 million in Q4 up to $77.6 million in Q1. So revenues are growing and margins are expanding. They're operating way more efficiently, which, as you know, is exactly what we want to see in the energy services space.
Now, when we slice up that revenue across their 3 main operating segments, Water Services takes the biggest piece of the pie at $191.2 million. But honestly, the real standout here is the Water Infrastructure segment. It hit an absolute record of $96.7 million for the quarter, which is a 19% jump from late 2025. This specific segment is basically the high-margin, highly predictable cash flow engine of the whole business. And it's clearly firing on all cylinders right now.
And you know, that infrastructure record wasn't just some accounting fluke. It was driven by sheer, massive physical volume. During the quarter, WTTR recycled or disposed of roughly 1.4 million barrels of produced water every single day. That is a gigantic operational footprint. It just highlights how incredibly integrated they've become into their customers' everyday production workflows. Moving on to part 2, the expansion. Let's look at their strategic acquisitions and infrastructure growth.
Looking at this chronologically, WTTR has been seriously busy locking down long-term contracts and scooping up strategic assets since the year started. First, in Q1, they signed a massive right of first refusal agreement up in the Northeast. They also nailed down a 12-year pipeline contract in the northern Delaware Basin. And then, early in May, they officially closed on the Black River Ranch and Delaware disposal acquisitions. They are just rapidly cementing their geographical footprint. Let's actually zoom in on those May acquisitions in the Delaware Basin, which cost them about $28.6 million. These weren't just impulse buys. They secured over 3,700 acres of fee land at the Black River Ranch, grabbed highly valuable water rights for 1,800 acre-feet annually, and added 30,000 barrels a day of disposal capacity, plus 500,000 barrels of storage. Basically, this is WTTR digging a massive competitive moat in one of the hottest oil and gas regions on the planet. And this aggressive physical expansion is exactly why CEO John Schmitz had the confidence to raise their full-year guidance. They're now projecting 25 to 30% year-over-year growth just for the infrastructure segment. And look, when management raises guidance based on actual physical contracts they already have in hand, well, the market definitely pays attention. All right, let's pivot to part 3, tracking their financial health and evaluating the balance sheet. To get a read on this, we're going to look at their debt-to-equity ratio. This is a crucial metric, sourced from macro trends, that basically tells us how heavily the company is leaning on debt to fund its operations versus using shareholder equity. In a super capital-intensive industry like water infrastructure, keeping your debt on a tight leash is literally how you survive those wild commodity cycles. And here's the crazy part. Even with all that aggressive buying we just talked about, WTTR actually managed to slash its leverage. They dropped their debt-to-equity ratio down to an incredibly safe 0.52 by the end of Q1. Now, this was partly helped by a recent public offering of Class A shares, which gave them the net proceeds to wipe out $70 million on their credit facility.
On top of paying down debt, they absolutely padded their liquidity. They took their cash reserves from about $18 million at the end of 2025 all the way up to $56 million in just 3 months. Think about that for a second. They are growing top-line revenue, they're expanding profit margins, buying up huge physical assets, and somehow still walking away with a de-risked balance sheet and a bunch more cash on hand. It's a pretty rock-solid fundamental picture.
Which brings us to the final part, Part 4, the valuation dilemma, fair value versus PE ratios.
A recent analysis by Simply Wall Street points out a super fascinating two-sided coin here. It basically pits a really optimistic cash flow projection directly against a pretty skeptical trailing earnings multiple. It's essentially this massive tug-of-war between the promised value of future contracts and the cold, hard reality of current earnings. Let's start with the bull case.
So on the bullish side of things, the most popular narrative pegs their fair intrinsic value at $21.83 a share, based on future cash flows. Since the stock's been hovering around the high $18 mark recently, this model suggests WTTR is actually undervalued by over 13%.
Now, that $21 target doesn't just come out of nowhere. It hinges entirely on those long-term infrastructure contracts we went over earlier. The whole theory here is that their massive backlog of acreage-dedicated contracts is going to turn into highly predictable multi-year cash flow. If they can hit their goal of a $400 million annual exit run rate for the infrastructure segment by late 2026, then yeah, that 21.83 price target looks incredibly reasonable.
But taking the opposing view, the bear case is rooted strictly in historical reality. Currently, the company's price-to-earnings ratio sits at a massive 108.9 times. That completely dwarfs the peer average of 32.9, and it blows past the broader U.S. energy services average of just 28.2. So if you're only looking through the lens of historical earnings, this stock looks ridiculously expensive.
And that huge gap forces us to really step back and weigh both sides. Like Simply Wall Street puts it, we have to ask ourselves, is this a genuine re-rating of the stock that future results will totally support, or has the valuation bar just been set impossibly high? There's a real chance the market has already baked all of this exciting future infrastructure growth right into today's premium price. And if that's true, there's practically zero margin for error if energy producers suddenly tap the brakes. So ultimately, I'll leave you with this thought to mull over as you do your own research. Will Select Water Solutions' massive physical expansion generate enough future cash to justify the market's sky-high expectations? Or is this stock already priced for absolute perfection? It is such a fascinating standoff between a rock-solid business expansion and an astronomical valuation multiple. Thanks so much for joining me on this explainer, and as always, keep your eyes on the data.